Your car is gone, declared a total loss. The insurance adjuster is polite, efficient. They email you a settlement figure. It seems low. You have a gut feeling. A feeling that the number on that screen doesn't reflect the true value of what you've lost. You are right, and what happens next, the words you say, the evidence you gather can mean the difference between accepting their first offer and walking away with $5, $8, even $10,000 more. This is not a theory. It is a documented, systematic process. And for the insurance industry, your ignorance of it is part of the business model. Let's dismantle the illusion first. The offer you receive is not a verdict. It is an opening bid. It is generated by a powerful, industry-standard software system with names like CCC1, Audatex, or Mitchell. The adjuster inputs your vehicle identification number. The software scours databases for recent sales of what it deems comparable vehicles. It applies adjustments for mileage, options, and a vague assessment of your car's condition. Then, it produces a number, the actual cash value, or ACV. This process is automated, and it is built on 3 assumptions that work against you. First, it uses auction data or dealer listing prices as a baseline, not the retail price you would actually pay to replace your car. Second, its comparables are often not truly comparable, a lower trim level, a different set of options, a car with 30,000 more miles. Third, it assumes an average pre-accident condition. Not your condition, not the condition of the car you meticulously maintained. The system's first goal is efficiency, not maximizing your payout. And it operates on a quiet bet that you will see the official looking report, feel overwhelmed by the jargon, and accept the number as final. But your insurance policy is a contract, and it promises to pay you the actual cash value of your loss, what it would cost to buy the same car in similar condition in your local market. The secret lies in holding them to the precise language of their own contract. This is where we begin our counteroffensive. Meet our case study, the 2020 Toyota RAV for XLE with 45,000 miles. This report is your Rosetta Stone. By law, in most jurisdictions, they must provide it. When it arrives, you are no longer looking at a single number. You are looking at their entire argument. Now you build yours. Gather every piece of evidence that proves your car was above average condition. Photographic evidence. Dig through your phone, not just the day you sold it. The Saturday wash, the road trip, the clean interior. These photos establish a visual history of care, the maintenance paper trail. This is your ammunition. Find receipts for new tires within the last year, a major value item. Oil changes at the dealership, not a quick lube shop. A recent major service, 60,000 mile service, brake flush, new brakes. A receipt from a professional detailing service is incredibly powerful. It translates a feeling of cleanliness into a monetary transaction that implies exceptional condition. The logbook, if you kept one, it's a gold mine. In our case study, the policyholder had $1,459 in recent documented maintenance. The software's average condition adjustment accounted for none of it. This is the critical mistake most make. They search for similar cars. You must search for mirror matches. Your goal is to find 3 to 5 listings for the exact year, make, model, and trim. The same factory options, a similar mileage range. Within your geographic area, you are not looking for dealer asking prices to blindly cite. You are conducting market research to prove the replacement cost, screenshot every listing. Capture the VIN, the price, the mileage, the full list of features. Now, compare these true comparables to the ones in your insurance report. In our case, the insurance software used to comparables with higher mileage and fewer options. The adjustment it made was insufficient. The true local market data revealed a gap of over $3,800. You have now transformed a gut feeling into a data-driven counter-argument. Armed with your dossier and your market data, you initiate contact. This is not an emotional plea. It is a professional, fact-based negotiation. Your tone is collaborative, but your preparation is absolute. Here is the exact framework. Hello, Mike. This is Tony regarding claim number to 561. Thank you for sending the valuation report. I've reviewed it and conducted my own research into the local market to ensure we arrive at a fair actual cash value that reflects my policy's replacement cost provision. I have compiled documented evidence of my vehicle's exceptional pre-loss condition, including receipts for recent major maintenance. I've also identified 3 retail listings for the exact year, make, model, and trim with comparable mileage within our area. Based on this evidence and the requirement to make me whole for a replacement, I am requesting a revised settlement offer of $25,500. I will email you my complete evidence file immediately for your review. When would be a good time to follow up tomorrow? Let's deconstruct the power of this script. 1. You establish control by stating you've done research. 2. You use their contractual language replacement cost. 3. You present a new, specific, and justified number. 4. You make it easy for them by providing the proof. 5. You set a clear expectation for a follow-up. The adjuster will often place you on hold to review the file. They may come back with a small increase. This is a test. Hold firm, politely restate your number and the evidence behind it. But there is one final, devastatingly effective tactic. The clause buried in the fine print of almost every auto insurance policy in America, the Appraisal Clause. In the event of a disagreement on the value of the loss, either party can invoke this clause. You hire a licensed, independent appraiser. They hire one. Those 2 appraisers select an umpire. The decision of any 2 is legally binding on the insurer. Mentioning this clause professionally changes everything. In your follow-up email, you add, for clarity and to ensure a fair resolution, I am prepared to invoke the formal appraisal clause in my policy if we cannot bridge this gap based on the documented evidence. For the insurance company, appraisal means guaranteed expense and ceding control of the decision. Suddenly, agreeing to your well-researched $25,500 figure is the most cost-effective path. You are not threatening. You are simply demonstrating you know the full extent of your rights under the contract you've been paying for. In our documented case study, the policyholder's methodical approach, the dossier, the mirror match search, the professional script, and the knowledge of the appraisal clause resulted in a final settlement of $25,500, an increase of $4,100. This is not a loophole. It is not a scam. It is the diligent execution of your right to a fair settlement. The system is designed for the passive claimant. It is vulnerable to the informed one. Your action plan is clear. 1. Request the full valuation report. 2. Build your pre-loss dossier and true market search. 3. Negotiate using the professional script. 4. Know your ultimate weapon, the appraisal clause. A total loss is disruptive enough. Financial compromise is optional. Knowledge is the only leverage they cannot adjust for.